Ever wished you could spot true market bottoms with confidence, moving beyond mere speculation? This isn't about intuition. It's about deciphering the consistent, undeniable evidence the market always leaves behind. By the end of this presentation, you'll possess the clarity to know precisely when to enter, when to hold, and when it's time to exit. Many traders miss a crucial detail. A true market floor isn't marked by a single event or indicator or just one sudden signal. Instead, a genuine bottom emerges from a sequence, a progressive series of actions that build up until the overall pattern is undeniable. I'll synthesize all these elements by the end, equipping you to apply this framework in your very next trading decision. First, however, we must approach this methodically, beginning with the broader perspective before scrutinizing the specifics. Various established methods exist for analyzing market structure, such as Wyckoff, smart money concepts, or price action. While their terminology differs, they fundamentally describe identical underlying market dynamics. Grasping the core mechanics makes specific labels secondary. Now, let's explore this sequence. Many robust bottoms, those preceding significant rallies, consistently follow an identifiable pattern. The first stage involves selling pressure dissipating as the market stops falling because sellers have simply run out of steam. Next comes a retest, where price revisits the lows, a pivotal step often completely misread by most traders. We will thoroughly examine this crucial retest phase in more detail soon. Should the market successfully pass this retest, a clear structural shift occurs. Price then breaks its downtrend from the inside. Only after the market successfully passes this retest and shows a structural shift should you consider initiating your trade position. Crucially, trading volume serves as the unifying element throughout this entire sequence, connecting every stage. It acts as the consistent thread, always indicating whether the price action you're observing is genuinely valid. Therefore, envision this process as a chain. Market exhaustion, a retest, a structural change, and finally, your entry. Every single step must be confirmed by volume. If any link in this chain breaks, the entire trading setup falls apart. It's important to understand that this pattern applies across any time frame, whether it's daily, 4-hour, or even 15-minute charts. However, the reliability of this bottoming pattern significantly increases when observed on higher time frames. For example, a signal appearing on a daily chart carries far more significance and weight than one on a 5-minute chart. Experienced traders utilize this by using the higher time frame to identify if they are within a potential bottoming zone. Conversely, the lower time frames are then employed to give them the precise entry point for their trades. Keep these principles firmly in mind as we now begin to construct this foundational chain, starting with its very first component. The initial phase of this process begins as the prevailing downtrend starts to noticeably lose its downward momentum. This is what it actually looks like. At a certain point during the price decline, a subtle yet crucial shift begins to occur. Despite continued heavy selling pressure, indicated by large volume and wide candles, the price ceases to establish significant new lows. The market's resistance to further decline, despite strong selling, resembles hitting a sturdy wall. This phenomenon is known as absorption. During this period, large entities are actively purchasing all available supply, resulting in high trading volume without a corresponding price drop. This discrepancy, significant effort yielding minimal price movement, serves as the initial indicator of an underlying market shift. This behavior is entirely logical, as major institutional players find it challenging to accumulate substantial positions in calm market conditions. Aggressive buying in low-volume markets would inevitably drive prices higher, making it more expensive for them to acquire their desired holdings. However, during periods of market panic, ample selling pressure provides the perfect environment for institutions to absorb shares without significantly impacting the price. Indeed, a state of market panic is often the sole opportunity for large-scale institutional orders to be fully executed. Therefore, when intense selling pressure fails to push prices lower, it signifies not weakness, but rather a strategic accumulation of assets. Following this, a natural rebound occurs as selling pressure diminishes, not from new buyers, but because sellers are simply exhausted. It's akin to releasing a submerged ball. It ascends not by its own power, but because the downward force has been removed. The crucial question then arises, was this a definitive bottom or merely a temporary halt? The market provides its answer by retesting the same price zone. This retest is not arbitrary. Traders instinctively reference prior levels, and the market is essentially probing. Can sellers regain control and drive prices lower once more? If this subsequent test occurs with significantly diminished volume, smaller price candles, and a clear lack of conviction, the market's verdict is a resounding no. The striking difference between the initial aggressive selling and the weak retest provides the initial, tangible confirmation of a potential shift. Following this, the market frequently enters a period of lateral movement, stabilizing horizontally. During this phase, trading volume diminishes, and the price fluctuation range becomes notably narrower. Though appearing uneventful, this stage is crucial. Buyers accumulate gradually, trade by trade, to avoid prematurely driving up the price. This measured accumulation is precisely why this particular market phase requires a considerable amount of time to unfold. Many investors misinterpret temporary bounces during this sideways phase as the bottom, getting trapped when prices fall again. It's important to note that not every market bottom necessarily includes the dramatic event that typically follows. Occasionally, the price simply establishes a higher low point and then proceeds to break out directly without further theatrics. However, the most prevalent and easily identifiable scenario incorporates one ultimate decisive test of the low. This critical test is what distinguishes successfully identifying a market bottom from becoming ensnared within its downward movement. This constitutes the very heart of the entire sequence, the ultimate decisive trap. After the market builds its base through absorption and sideways movement, price briefly dips below the established floor. It then rapidly snaps back into the range, appearing like a resumed downtrend, but it's merely a deceptive maneuver. This triggers stop losses and draws in late sellers, only for the market to reverse, leaving them trapped on the wrong side. However, not all traps are created equal. It's crucial to distinguish between a high-quality setup and a potentially dangerous one. The key factor in this assessment lies in one question: how much genuine selling activity occurred during that initial price breach? When the price dips below the established support with noticeably low volume, almost uneventfully, that's actually the most positive indicator. This signals that the available supply has virtually dried up, indicating a significant absence of sellers in the market. Such a scenario provides a clear path forward, allowing for confident action without much hesitation. If the break occurs with moderate trading volume, the trap remains valid. But prudence dictates waiting for a subsequent, quieter retest. This calm revisit serves to confirm that sellers have indeed exhausted their efforts before making a commitment. Conversely, a break accompanied by heavy volume, characterized by wide candles and aggressive selling, represents the most volatile form of this pattern. In such instances, it's evident that considerable supply still exists within the market, posing a greater risk. You'll encounter this aggressive variant more frequently in thinly traded assets like crypto, where lower liquidity amplifies price movements. While it serves the same trapping function, its uglier nature demands greater patience, requiring a clear retest before any engagement. Regardless of its quality, remember that the trap itself isn't the ultimate bottom. Rather, it functions as the final decisive test. What follows this critical event is the irrefutable proof of the market's true direction and stability. So, the trap clearly works, but what truly underpins its effectiveness? Let's now explore the underlying mechanics. We've
Now,
established the
if we
trap's
look at the
clear
whiteboard
effectiveness,
here,
but
the
what truly
relationship
happens
between
beneath the
these two
surface?
variables
Let's
becomes
now uncover
clear.
the fundamental
And
mechanics
notice here,
driving this pattern. When the price holds steadfast at a clear support level for an extended period, a significant number of orders accumulate just below it. Stop-loss orders. Traders who have purchased within that price range typically position their protective stops precisely beneath these established low points. Interestingly, short sellers also tend to place their entry orders at these identical critical price levels. The core mechanism is straightforward. A stop-loss order automatically converts into a market order the instant its trigger price is hit. This specific operational detail regarding stop-loss orders is explicitly described and documented by regulatory bodies such as the SEC. In futures markets, research using CME data shows these stops remain invisible in the order book, only appearing once they are actually activated. Consequently, when the price finally breaks through that established floor, all these previously hidden stop orders fire simultaneously. This sudden, synchronized activation unleashes a powerful wave of forced selling pressure throughout the market. In fast-moving markets, this dynamic creates what New York Fed researchers call self-reinforcing price cascades, where selling briefly feeds on itself. However, this is precisely why the reversal occurs. This intense selling isn't driven by investor conviction, but by purely mechanical, automated stop triggers. Once these initial stop orders are exhausted, the wave of forced selling abruptly ceases. Many traders who were stopped out then often re-enter as buyers or cover their short positions. Thus, the trap inherently generates its own fuel for the subsequent reversal. A time-based variant also exists in forex, often around session openings. Ultimately, the trap is not a mysterious phenomenon. It is underpinned by clear, understandable market mechanics that can be observed and analyzed. In markets like forex and indices, a similar trap often manifests as a time-based variant, particularly around the opening of major sessions like London or New York. However, for cryptocurrency markets, which operate 24/7 without distinct session breaks, this specific timing element holds less significance. Despite this, the underlying structural pattern remains identical across all markets. An initial break, followed by a reclaim of the level, leading to significant displacement. This highlights that the trap isn't an obscure event, but rather one driven by tangible market forces and clear mechanics. Grasping these fundamental principles empowers you with greater confidence in interpreting its formation and potential outcomes. So, after the trap has played out and the forced selling is absorbed, a crucial question arises. How can we be certain the market has truly passed this test? The essential proof we seek to confirm this underlying shift in sentiment is found within the market's structural behavior. Specifically, we look for price to decisively break above the most recent significant lower high, which represents the final point where sellers held sway. This breakthrough must occur with clear displacement, not a gradual ascent, but a forceful, impulsive move that shatters the previous resistance. In the terminology of smart money concepts, this particular event is known as a market structure shift. It's a highly effective phrase, succinctly indicating a fundamental change in the market's character from a bearish to a bullish sentiment. This forceful displacement is critical as it signifies more than just buying pressure. It confirms that the supply at that price level has been entirely absorbed. Such rapid moves frequently leave behind an imbalance, a noticeable gap in price where the action was too swift to fill every order. This resulting price gap often becomes a crucial reference point for potential entry opportunities later on. This event unequivocally shows that all existing supply at that price level has been entirely absorbed. Such rapid movements often leave behind a price gap, an imbalance crucial for later entry relevance. For a more conservative strategy, consider waiting until the price convincingly breaks above the entire preceding range, beyond the initial bounce's high point. This offers a broader, yet significantly stronger, confirmation of the market's directional shift. The underlying concept is quite straightforward. Once the market's trap has successfully cleared out the last remaining sellers, there is simply no supply left below that price range to stop it. Consequently, when buyers then exert pressure, they encounter no resistance, which is precisely why the subsequent price movement becomes so impulsive. Displacement isn't merely about exceptionally strong buying activity. Rather, it signifies the complete and utter absence of selling pressure. The market's path of least resistance has demonstrably changed direction. Once this compelling proof emerges, you have received your definitive green light. Now, we arrive at the crucial detail you've been anticipating, the exact point of entry. This is where all the preceding observations finally converge into an actionable plan. You've witnessed the market successfully absorb all selling, the trap has sprung, and price has snapped back, with structure shifting through displacement. So, with this clear setup, precisely where do you initiate your trade? The fundamental principle here is do not chase the market. After that powerful, impulsive move confirming the reversal, price frequently retraces, offering a more calculated entry. This pullback is your primary opportunity. If the market does not retrace, it's a trade you should simply bypass. It is far better to miss a potential trade than to chase one impulsively and risk losses. You should look for the price to pull back into one of two specific zones formed by the displacement. The first is the order block, the consolidation right before the impulsive move, often acting as support. The second is the fair value gap, that imbalance we discussed where price moved too fast. Price tends to return to fill this gap before continuing. So, three things need to align. To execute a successful trade, three key elements must align. First, confirmation. The initial trap must have occurred, shifting market structure. The second crucial element is location, meaning the price has pulled back into one of those specific zones we identified earlier. Finally, you need a trigger, which is a clear rejection of lower prices occurring within that designated zone. This could be an engulfing candle closing above the zone's midpoint, or a hammer pattern signifying strong buying pressure. For risk management, place your stop loss either below the entry zone or beneath the trap's lowest point for a wider approach. Should the price decisively break through your intended zone, your trade idea is invalidated and it's best to exit quickly. When these three conditions, confirmation, location, and trigger, converge, you have an engineered entry, not a mere guess or impulsive chase. This creates a robust setup where every aspect supports your decision. Crucially, throughout this entire sequence, one element has been consistently present: volume. Let's connect these observations. Recall the initial heavy selling, the panic that the market absorbed. This was characterized by exceptionally high volume. The initial volume spike is your critical reference. Later, the market retested the same area, but crucially with significantly less volume. Such a stark contrast reveals that sellers attempted another push, yet lacked the conviction and numbers seen previously. During the subsequent sideways consolidation phase, volume typically contracts, indicating reduced market activity and tighter price ranges. This behavior isn't stagnation. Rather, it signifies supply being quietly removed as trades are absorbed without major price shifts. This sequence then transitions into the trap phase, where specific volume characteristics will further clarify market intentions. In this crucial trap phase, volume emerges as your most potent diagnostic tool for understanding market intentions. If a trap occurs on low volume, consider it a premium signal. It indicates sellers have exhausted their supply and are no longer a factor. Conversely, a trap accompanied by high volume demands caution. Significant supply remains, necessitating a patient wait for a retest. Following the trap, as market structure shifts and prices begin to climb, we look for volume to expand during upward movements. Simultaneously, it's crucial to observe volume contracting during any subsequent price pullbacks or corrections. This pattern signifies that demand has taken control, with each successive rally further confirming the market's reversal. Underlying all of this is a fundamental principle: the relationship between effort and result. Volume represents effort, and price movement is the outcome. When substantial effort yields only minimal price movement in a particular direction, it indicates strong absorption by the opposing market force. Conversely, when minimal effort results in significant price change, it suggests that the market has discovered the path of least resistance. For those trading cryptocurrencies, an important caveat is that volume data often isn't as straightforward or clean. Practices like wash trading and activity unique to specific exchanges can artificially inflate reported volume figures. Therefore, it's more effective to focus on relative volume changes, increasing or decreasing compared to prior stages rather than absolute values. Ultimately, volume acts as the consistent thread unifying every market stage. When you interpret it across the entire sequence, you discern market intent, not just patterns. However, I'd be remiss not to clarify that this methodology isn't infallible. It doesn't work every single time, so next we'll explore its limitations. It would be misleading to suggest this strategy is foolproof. It certainly has its limitations. We must therefore discuss scenarios where this analytical chain might break down. The primary failure indicator is when a perceived trap doesn't swiftly reverse. Should price fall below a support level and fail to recover into the previous range, it's not a false move. Instead, this signifies an authentic market breakdown. The stop-loss cascades previously discussed can then create a powerful, self-perpetuating downward spiral. Such a breach below critical lows often initiates a continuation of the trend rather than signaling an impending reversal. Therefore, two elements are always required: a price reclaim back within the range, coupled with an observable structural market shift. Simply breaking the low is insufficient proof. The second failure occurs when the intended entry zone fails to hold. Price might retrace into an order block or fair value gap, only to cut straight through it without hesitation. In this situation, the former support level transforms into resistance. This provides clear, invaluable information, unequivocally signaling that your trading thesis is incorrect. We must also be transparent about the statistics. Setups based on this logical framework typically achieve win rates ranging from 59 to 65%. This implies that approximately 4 out of every 10 trades will ultimately fail. Such outcomes are simply an inherent aspect of how financial markets operate. Consequently, the importance of proper position sizing cannot be overstated. Even with a 60% advantage, over-leveraging can lead to ruin from a series of losses before your edge can manifest. The ability to recognize when to disengage from the market is a skill equally as vital as knowing precisely when to initiate a trade. To synthesize these insights, a true market bottom is never a mere conjecture. Instead, it is meticulously constructed from a coherent chain of confirming evidence. The initial piece of this evidence chain is the exhaustion of selling pressure. This is typically signaled by exceptionally heavy trading volume. This high volume indicates that all available sellers have finally capitulated, paving the way for potential price stabilization. The market then typically revisits that support area, but with significantly less momentum, solidifying the idea that selling pressure has truly subsided. Following this, the ultimate trap often unfolds. Price dips below the established floor, forcing out final sellers before quickly reversing upwards. The strength and swiftness of this rebound from the trap are crucial indicators guiding your subsequent strategic decisions. Next, observe the structural shift as price decisively breaks the prevailing downtrend, initiating a new upward movement from within its previous confines. Your entry point is meticulously planned, targeting a retracement back into a key order block or fair value gap, confirmed by a precise trigger candle. Throughout, volume provides critical confirmation. Heavy initially, lighter on retests, diagnostic during the trap, and strong during the advance. Should even a single component of this robust evidence chain be absent or incomplete, the prudent course of action is to simply remain on the sidelines. Specifically, if the trap fails to recover convincingly, or if price does not reclaim the broken level, it's a clear signal to disengage from the potential trade. Similarly, without a definitive shift in market structure, where the downtrend is clearly broken, there is simply no valid setup to consider. Crucially, always begin your analysis on higher time frames. This ensures you are operating within the correct broader market context. This comprehensive framework encompasses every detail I initially promised, outlining the complete sequence for identifying market bottoms. Now, armed with this step-by-step methodology, you are equipped to confidently recognize and act upon potential market reversals. Mastering these intricate market dynamics allows for a profound understanding of price action, transforming speculative guesses into calculated opportunities. If this deep dive into market structure has empowered your trading, consider subscribing for more insights and continue your journey to mastery.